So here we have the Dow Jones Industrial Average chart on a daily chart, and you can see here this is from near the end of 1929-1930, so basically the start of the Great Depression. This area here represents where the market peaked at an all-time high, ATH, of 386.1 points. You can see here that there was a market drop, obviously change of trend at this point. You can see obvious lower bottoms and lower tops, a very good sign that there's something amiss in the market. And you can see here from this the next low in the market, 320.5 points, that we had a retracement up to an area around about 50% of the distance between the all-time high and that next low. If we have a closer look at that, you can see that we were testing this 50% retracement, and our tails from our candles were peeking up through there, but we were basically right on that 50% retracement mark with regards to closes and opens until we get these red candles heading back down. Going back to our daily chart, you can see here that from that point we dropped a long way down to 195.4 points. Now this is only 2.4 points above a mark that is a 50% retracement from the all-time high of 386.1 points and 0. So that's a significant resistance point there, and you can see that it didn't quite make it, and it bounced well and truly from around that area. From that point we went up and retraced that fall to a point very close to the 50% mark from the all-time high of 386.1 points to that more recent low of 195.4 points. We can have a closer look at that here. As you can see from this close-up of the next high in the chart, we had some very scratchy looking candles heading back up to this 50% retracement zone around about 291 points. All these candles have extended tails top and bottom, and that generally is a good indicator that the bulls and the bears are having a right royal battle as this bull market continues. Now, even though we did pierce up through that 50% retracement, you can see here that it really stalled around about that 295 point level, which you might regard as a natural resistance point at a round number. You can also see here that we have what's called a doji. That's where the open and the close price are exactly the same, and you have a long tail high and bottom. And then that was followed by a very strong bear signal with this engulfing pattern, a strong red candle that engulfs the previous candle. From there we went down to a new low point at 249.8 points, and a very strong bounce from that point. And the 50% resistance mark or retracement mark between that new high and the new low was at 274 points. Now we retraced to that point, and the candles do indicate that we went up through there and did have an open and a close above it. But again, we had this doji, another doji, which indicates a balancing point, and then a strong engulfing candle to lead us to a new higher low. Again, we bounced up through that resistance point, but we didn't get any higher than that previous high, so that might well be regarded as our next lower high. And it was from there on a very strong bear run down to the lows some 2 years later of about 40 points. So now if we look at the big picture, called up a monthly chart of the Dow Jones Industrial Average for that period, and you can see here in the yellow box, that's what we've just been recently examining, that all-time high to the next low up to that next high, and we just recently looked at a close-up of that area in a daily chart. what I'd like to do now is to come forward to present day and in fact the global financial crisis. And what I've got here is the same chart, the Dow Jones Industrial Average chart, but we're looking now at a weekly time frame for each candlestick. Now the way I'm looking at this is that we have a very similar pattern that's formed compared to what I was just showing you a few minutes ago. We have our all-time high coming off that to a new low, and then a near 50% retracement for a bounce down to around about an area that's 50% of a retracement from the all-time high to zero. Now we did actually go through that, but it was only for a relatively short period of time, and then very quickly, even compared to the Great Depression, we bounced back up to the 50% retracement between the all-time high and that more recent low. Now another thing I'd like to speculate on is that this area here you could relate to the US markets where all those bad housing loans started to go sour, and the ninja type loans, the no income, no job, no asset loans were starting to collapse. There was defaults on mortgages, etc. This area here is more related to the global financial crisis, where all the investment banks over in the States, in Europe and Great Britain were realizing that their loans that were related to the mortgage loans that were sliced and diced in the States weren't actually AAA rated, and consequently it wasn't until around here that they were all starting to get bailed out by the US government and the other respective governments. Now we've had a very strong pullback from there, but there's been a lot of talk more recently about sovereign debt and how there are many countries in the world who just can't afford to pay their way anymore. Late last year we heard of Dubai, who were very close to reneging on some debts, and more recently we've been hearing about Greece, Spain, Portugal. There's a number of Eastern European countries, or the Latvian countries, and I would say that with the amount of debt that the US is building up, they're probably looking a little bit shaky as well going forward. Now if you can imagine that we've had this kind of a decline here, with business debt and investment bank debt being out of control, imagine what sort of effect we'd had if countries, particularly the US, were looking shaky in that respect. Now I can envisage that we could well and truly repeat what's happened in the Great Depression, and that this market could come down potentially to 1/10 or 10% of that 14,192, which was the all-time high in the Dow Jones Industrial Average. And that being the case, we're looking at about 1,500 points for the Dow Jones. The only difference is, looking at this time frame, it could well be quite a few years off into the future. All I can say is that we need to just keep our eye on what's happening to make sure that our long-term investments aren't being severely affected by a potential catastrophic bear market.